This is a very interesting slide because remember that it's now almost 5 years since the 4 years since the COVID pandemic, and interestingly, I also put out a commentary about stock price performance in the post-COVID era over the last 4 years. Do take a look at that. That's on our website. But here we are going to be talking about something different, which is not stocks, but about countries and their response to the pandemic. Now, what most countries did in response to the pandemic was essentially use the fiscal to support the economy. So the fiscal deficit went up in most cases. And when the fiscal deficit goes up, because you are effectively borrowing money, the debt to GDP also goes up. Now, of course, over here, we are looking at non-financial services debt. So this means this is the debt of households. Households may have also resorted to debt because during the pandemic, they didn't have income. Businesses did not have revenue, so maybe they also had to access debt, and governments also added on debt. So what this chart shows you is the table of where was the debt to GDP, non-financial services debt, as a percentage of GDP in 2019, where was it in 2023 December, and what was the peak number. And what you can see over here is that in every economy around the world, there was actually a significant increase in debt as a percentage of GDP. And of course, by the time you get to 23, the number starts to pull back down. I think what is most remarkable, and at least from an India point of view, what is good to see on this chart is, of course, in India's case as well, we do have an increase in the debt to GDP compared to where we were in 2019. But the good point is that on an absolute basis, non-financial services total debt to GDP of the Indian economy at about 169% is much below comparable numbers for other economies that you see here, particularly the most indebted, of course, being Japan, followed by China, and US not too far behind because they are still continuing to run very large fiscal deficits. So this is just a sense of how governments and other constituents in the economy, households and businesses, had to raise debt to survive the pandemic and how their numbers are looking post-pandemic. On the next slide, we have just dived in to look more closely at only two economies. One is India, the other is China. And you can see the overall debt to GDP of India and China on the left-hand trajectory. Now, what is interesting over there is that when you look at the numbers, you will see that China's number actually starts to take off after the global financial crisis. That is not a pattern which actually happens in India. India actually tends to stay flat. But China's debt to GDP starts to explode after the global financial crisis. That is when they actually also had this huge property boom, which was the way that they used to ensure that the economy continues growing, because exports, even though they were growing, the bigger contribution actually came from investments, and investments were driven by real estate. And that is why actually their household debt and other numbers start to really spike up very, very significantly. And therefore, by the time you get to 2023, China's debt to GDP reaches 311% of GDP. India's is at about 175%. Now, some of these numbers may look slightly different from the previous slide. That's just because of a difference in dates and difference in terms of the data providers. But essentially, directionally, there is no big difference between the two numbers in terms of the way they are behaving. On the right side of the slide, you can also see the overall split of debt. Right? So who exactly is holding the debt? Now, what you can see over here is that in India's case, of course, it is dominated by debt of the government. That's almost equal. So debt of government is 83% of GDP. Households and non-financial corporations are again equal to about 85-86% of GDP. In China's case, government debt is actually lower as a percentage of GDP, but households are far more indebted and non-financial companies are significantly leveraged. But I must point out that in China's case, many of their companies which are leveraged actually belong to the state. They belong to yeah, not the central government, but to their individual provinces, as they are called, or to local bodies. And these are the entities that have typically leveraged up very aggressively for developmental purposes. But be that as it may, you can see that therefore the non-financial corporation number of debt is really the very, very big number as far as China is concerned. So this is just the difference between the two. Pure sovereign debt to GDP, both economies are comparable, but on household and non-financial corporation, China is far more leveraged. So these are just two big pictures that we wanted to share with you in terms of where we stand in terms of debt post the COVID period.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.